Bitcoin ETFs pulled $936 million in a single day, and that's just the beginning. Is this Bitcoin's second act? Let's break down exactly what is happening in the world of Bitcoin and what it means. If you really want to know where Bitcoin is headed, you definitely should start with the money trail. Ask yourself, where's the cash going? Well, recently, money has been going into a brand new pipeline called spot Bitcoin ETFs. The US approved them in January 2024, and these ETFs have since swept up a lot of Bitcoin from the open market. In fact, by May 2025, over $40 billion had been pumped into spot Bitcoin ETFs, indicating sustained interest and confidence from retail and institutional investors, pension funds, hedge funds, and professional managers. But not all spot Bitcoin ETFs are created equal. BlackRock's IBIT ETF stands tall in the crowd, with a whopping $87.7 billion in assets under management as of August 15, 2025. With this kind of scale, a liquidity hub is formed where buyers and sellers know they'll find a deep market. Yet, we've not even touched on the craziest part of these flows. On April 22, 2025, Bitcoin ETFs raked in $936 million in a single day, more than 500 times the daily average. However, these flows go both ways. On March 28, 2025, Fidelity's FBTC ETF saw $93.2 million redeemed, breaking a 10-day streak of positive inflows into spot Bitcoin ETFs. With all said so far, we can conclude this: ETF flows are Bitcoin's heartbeat. When there is an inflow of cash, price and sentiment pulse higher. When there is an outflow, the market dips. For something so technical, halving always hits the Bitcoin market hard. And just to ensure we are on the same page, halving is an event that happens every 4 years, during which Bitcoin cuts the reward for mining new blocks in half, hence the name. The latest halving occurred on April 20, 2024, cutting the reward for mining new blocks from 6.25 BTC to 3.125 BTC. That's like your employer saying, "Hey, you'll be doing the same job, but you'll get half the pay." You wouldn't like that, and neither do miners. Each halving cuts the new supply of Bitcoin entering circulation by 50%, and with fewer Bitcoins getting into the market, scarcity pressure becomes real. But don't get carried away. That scarcity doesn't necessarily mean bullish Bitcoin prices. Miners, especially smaller ones, can't keep their rigs running profitably at half the rewards. Consequently, they shut down. A devastating series of events then follows. The industry consolidates and bigger miners weather it out while smaller ones pack up. The number of miners drastically reduces, translating to fewer natural sellers in the market. It's certainly not good news for anyone hoping for cheap Bitcoin, right? But here's the part most analysts miss. For a long time, critics haven't been rosy about crypto. Their sentiment has been that it's all about speculation. Buy low, hope to sell high, and then brag on social media or to friends and family. However, 2025 is shaping up differently. Crypto is gradually gaining mainstream status. Stablecoins in particular aren't anything like Bitcoin. They're pegged to the USD and are increasingly gaining real-world acceptance. Stablecoins are now used for remittances, e-commerce, and payments. Even Goldman Sachs couldn't resist dubbing 2025 the summer of stablecoins, after new regulations finally allowed major players to experiment with real adoption. For scale, Ethereum hosts approximately 70% of the stablecoin supply, with decentralized versions like DAI and FRAX accounting for about 20%. And DeFi, decentralized finance, now witnesses about $60 billion worth of activity via stablecoins. Considering those numbers, stablecoins really have an impact on the economy. Now, Bitcoin has also evolved a lot from its former days when it was deemed slow and clunky for payments. However, new Layer 2 networks are changing that. Years ago, in 2021, there were only about 10 credible projects working on L2 solutions. Fortunately, that number had jumped to 75 in 2023, making Bitcoin faster, cheaper, and more usable for payments, transfers, and app development. While many people still don't view it as such, Bitcoin is now a significant part of the global money machine. To prove this, Coinbase even built a global M2 liquidity index. And you know what? That index has been predicting Bitcoin's price 110 days in advance. Simply put, if liquidity goes up, Bitcoin follows suit a few months later. And what's happening at the moment? Well, liquidity is going up. There is a reason all this is happening in 2025, though. The era of hard quantitative tightening is easing. Central banks are injecting more liquidity into the system, partly through quantitative easing. And when that happens, that money isn't held in government bonds alone. It trickles into risk assets like tech, stocks, and of course your favorite crypto, Bitcoin. Now, crypto tends to be hypersensitive to liquidity, a little extra global confidence, and crypto rallies harder than most asset classes. But it works both ways. When central banks slam the brakes, speculative appetite dries up fast. Inflation, GDP, and interest rates matter, but liquidity is the puppet master pulling Bitcoin strings. So, to forecast Bitcoin, pay attention to central bank balance sheets and policy shifts. Of course, no comeback story is without hiccups, and Bitcoin's Act 2 faces some real threats. First, regulation. The US is working on new bills requiring banks and non-bank stablecoin issuers to hold strict reserves, sometimes even under Federal Reserve oversight. That's great for stability, but it could also choke out smaller, innovative players who can't meet those requirements. Second, concentration risk. Right now, a handful of ETFs dominate Bitcoin's institutional flows. When one product like IBIT holds a massive share of total Bitcoin ETF assets, the entire market leans on a few giants. That concentration creates a fragile system where one misstep could ripple out fast. Third, dependency on stablecoins. Ironically, the very tokens driving adoption could also pose systemic risk. Centralized stablecoins like USDC or USTD are tightly linked to the legacy financial system. If regulators crack down or reserves falter, a huge chunk of crypto's liquidity could freeze overnight. And don't forget the wild card, legacy supply overhang. Millions of bitcoins are lost forever on old hard drives or stuck in dormant wallets. But if some of those sleeping giants ever move, it could rattle the market. That's speculative, sure, but it's a cloud always hanging overhead. But what if Bitcoin doesn't become money, and instead becomes something bigger? Leave your thoughts in the comments below. And if you've enjoyed the video, subscribe, and watch this one.